What is going on, investors? Welcome to my channel. This is Jason, aka the Frugal Investor. This is going to be a quick video in which we are going to see how to read an income statement. The purpose of an income statement is to give you how much income a business is making, what are the expenditures, how profitable is the business, basically to give you an idea of the profitability of a business. In this video, we are going to analyze the income statement of one of my holdings, which is Kimball Electronics, which is one of my biggest holdings in my portfolio. We're going to analyze its income statement and we're going to look what income is the business generating, what is its profitability like, what are the expenditures, what are the expenses, how much profitable is the business. Okay, so when we are reading an income statement, I like to go use Seeking Alpha. Seeking Alpha, I go to annual income statement, so I like to look at previous 10 years income statement. So a general income statement, it starts with revenue. It shows you how much revenue the company has generated over the past 9 years, 10 years. So as we can see, in case of Kimball Electronics, the top line, that is the revenue, has gone up. It is a trend that the top line has been going up over the past 9-10 years. There are no other revenues. The total revenue, which is also the top line, has been going up over the past 9-10 years. The cost of revenue, which is the money that they used to generate that revenue, as we can see, has also been going up. The gross profit, which is the total revenue minus the cost of revenue, as has been going up. So the gross profit, it has to go up, and the percentage has to go up eventually as well. That is what I'm looking for, that the business is increasing the percentage by which they are profitable over time, along with increasing the top line. And as you can see, it has been doing that over time. The percentage has also been going up over time as well, in case of Kimball Electronics. So it gives us the top line, it gives us the money that is needed to produce that top line, and it gives us the gross profit, that is the expenses minus the top line. And when we are looking at the gross profit, the percentage has to be growing. Not only the gross profit has to go up, but the percentage also has to grow up, because that means the business is evolving, it's maturing, its facilities are doing better and they're becoming more profitable and more efficient. Again, then moving on to the next part, which is operating expenses and income. So this gives us the selling, general and admin expenses, basically how much money they are using to generate sales, how much money they're using in marketing, how much money they're using in different things like that. So this business, Kimball Electronics, very simple, very easy to understand. It's very simple business. And so basically the selling, general and admin expenses for them is has been going up. So this can be, sometimes some businesses, they also like to mention in here, in selling, general and admin expenses, management paid outs. So if they are giving the management paid outs and all that kind of basic stuff, they add it in selling, general and admin expenses. So you have to go to the proper 10K and 10Q to understand what is included in the selling, general and admin expenses. But to get a basic idea, when you are overlooking a business, to get a basic idea, the selling, general and admin expenses contains the sale expense, the marketing expense, the administration expense, what they are using to generate, to keep the company running. This is the operating income. So operating income is the gross profit minus all the operating expenses. So whatever the operating expenses the company is using, selling, general admin and other operating expenses, minus that, whatever is left out, that is the operating income. Very important metric. Generally you want to do the percentage to go up over time, and also you want to see a general trend of this going up over time as well. Moving on to interest expense. Interest expense is basically anything that the company is paying in interest on its debt that is taken from the bank. So anything that is paying in interest is mentioned over here. Interest and investment income is basically any interest and investment income that the business is making from its cash holdings, from its certificate of deposits, from its money market accounts, from its, sometimes the businesses hold other securities of fellow businesses, and that is also mentioned here. So whatever investment income they're making, then it's net interest expenses. So this is basically interest expense minus the investment income, that is the net interest expense, is mentioned here. Currency exchange gains, losses. So they do a lot of international business, so whatever the currency exchange, sometimes they lose money in exchanging currency, sometimes they gain money, so that is mentioned here. Other non-operating income could be anything related to the facilities, to other expenses, maintaining the 10K to 10Qs, anything like that is mentioned over here. earnings before taxes exclusive unusual items is mentioned here. Earnings before taxes including unusual items is mentioned here. Income tax expense is mentioned here. Of what taxes they are paying, that is mentioned here. And the earnings from continuing operations basically are right here after all this is done and said. Now, the next thing is net income to company. What is the bottom line? What is the company making after everything is said and done, after all the expenses are paid? How much is the company keeping to itself? That is the net income. So net income is mentioned here. Generally, you would want to see it going upwards. In this case, it's fluctuating. It's fluctuating because of a lot of reasons. It's fluctuating because of taxes. There's a lot of taxes some years that they're paying. That is one of the main reasons that is fluctuating so much. Other than that, there can be a lot of other reasons. There can be currency exchange losses or other reasons, any other losses that they are facing that can lead to the reduction in the net income. And if you have to go to the 10Ks and the 10Qs to identify what the reason is for this year that they didn't make this 10K, that they didn't make this net income to grow, that they didn't make this net income to go up, which has to be the trend in the long term. So moving on to the next part is preferred dividend and other adjustments. So preferred dividend and other adjustments is basically preferred stock at par value, whatever dividend they are paying for preferred stockholders. So preferred stock is a way to raise capital for companies. A preferred stock is something that can be traded for multiple amount. Like one preferred stock can be traded for five common stocks when a stock reaches a certain price. Generally, the preferred stock, let's say if the company is trading today at $30, so the preferred stock, the value of the preferred stock generally is $45. It's higher than what the company was trading at when the preferred stock was issued. So generally it's $45, $50. And there's a condition that if it reaches that, either that can be cashed in for common stock or it can be cashed in before that in exchange of multiple common stocks. So preferred stock also sometimes they give out dividends. So as we can see, that preferred stock dividend will be mentioned here. Net income to common inclusive extra items. After this preferred stock dividends is mentioned, deducted from that, that is what the net income is left after that. Now moving on to the next part, which is very interesting and very important as well, revenue per share. So this is the revenue per share. This is the top line per share that the company is generating. As you can see, it has been going up over time. So the revenue per share is mentioned here and it has been going up over time. Basic earning per share. So basic earning per share excludes the preferred stocks. So preferred stocks and all the dividends are excluded from it, and whatever the common stock is, on that common stock, what are the earnings per share is called basic earnings per share. As you can see, the basic earnings per share, generally I want to see it going up over time as well. Basic earnings per share from continuing operations. So basic weighted average shares outstanding. This mentions how many shares are outstanding for the company. Generally, you would want to see it going down, that the company is doing share buybacks, which is a good thing. So this company is doing share buybacks and it has been doing that for the past 9-10 years. So that is a really good thing. Diluted earnings per share includes the preferred dividend stock. So let's say the company issued 100,000 preferred dividend stocks, and what is the value of those preferred dividend stocks if they are converted to common stock? That plus the common stock will give you the net amount of diluted earnings per share. So that diluted earnings per share includes the preferred dividend stock, the par on the par values and all that. So diluted earning per share is also going up over time, and the diluted earning per share for continuing operations is also mentioned here. That is also going up over time. Diluted weighted average share outstanding, that is what is the diluted amount of shares outstanding after including the preferred dividend stock issues. That is also mentioned here, and it's also going down over time. Normal, so you can see the preferred dividend stock is 200,000 if you minus this one from the basic number. So the next is the normalized basic earnings per share. What a normalized basic earnings per share is, basically after all the unexpected expenses have been taken out from the bottom line, what is left after that per share. That is the normalized basic earnings per share. The unexpected expenses could be something related to the facility, something related to the building, something related to transportation, something related to employees, something related to litigation, anything. It could be anything. So basically all the one-time expense that is just happening this year, after that is taken out, what is left in the bottom line per share, that number is called normalized basic earnings per share. And normalized basic earnings per share excludes the preferred dividends again, and normalized diluted earnings per share includes the preferred dividend shares again. EBITDA, it's earnings before taxes, depreciation, and amortization. I really don't look at EBITDA because I don't think it gives out the correct metric to look at. But if you, it's that's what EBITDA is. Generally, it's going up over time, as you can see right here. Earnings before taxes and depreciation and amortization. That's going up over time. Earnings before taxes, it's going up over time. Earnings before taxes, depreciation, amortization, and rental costs or restructuring costs or whatever, that is also going up over time. EBITDA is EBITDA or EBITDAR or EBIT. All this terms, these are not really significant number. I focus on net income and diluted earnings per share and cash flow per share, but EBITDA is also mentioned in the income statement. So effective tax rate, what the company is paying in taxes. So as we saw, the diluted earnings per share for the year 2018 was very less because of the taxes. The tax rate was 62% for that year. So as you can see, the tax rate, you can see how much the company is paying in taxes per year, and based on that you can see how the fluctuations in the net income and the bottom line. So normalized net income is mentioned here after all the expenses and all that. That is the normalized net income. Interest on long-term debt. So long-term debt, it mentions the interest on long-term debt and how much the company is paying on interest in the long-term debt. Research and development expenses from footnotes. So this is the research and development expenses. As you can see, it has been going up over time. So the companies that I hold that are in manufacturing, that are doing products, that sell certain kind of products, that are in medical devices, or that are in some kind of farm products or fertilizers, so stuff like that, which are like, evolving in a way where that on those companies, I want to see this research and development going up, and at least certain portion of the net income, because they need a lot of research and development to develop new products, to develop better products, to beat the competition out, to build that moat around them. The more research and development they do, the better the company is. So that is what this also mentioned here, research and development. Then comes the foreign sales, how much the money is being generated from the sales in different countries other than the United States. So that is the number for foreign sales as well, is mentioned in the income statement. So basically, income statement, it gives you an idea of what are the general expenditures of the business, what are the biggest expenditures of the business, what is the profitability like, what is the bottom line like, what is the gross profit like. It gives you how basically the business is managed, what the debt is, how much interest is being paid out in debt, if it's manageable or not manageable, if the debt payment is manageable or not manageable, if they are paying out all of their income in debt, what are the taxes like, what are other expenses like. That gives you a basic idea, okay, of what the company is. It gives you an idea of how much the preferred stock is, because too much preferred stock is also not good. So it gives you a basic idea of like how the company is doing at a particular time. And on Seeking Alpha, I can do it in absolute, or I can do it, year over year growth. I can do the percentage. It gives me a percentage of if it's going up or down. So it generally gives you a basic idea of what the business is like, and that's a general idea of income statement. In the next video, I'll do a balance sheet, and the video after that, I will do a very nice overview of cash flow. If you like this type of content, please don't forget to like and subscribe. This is the Frugal Investor signing out.